You've probably heard the VIX called the market's fear gauge, right? But what is it actually measuring? In this explainer, we are going to go right under the hood, deconstruct the exact math, and see how a whole mess of complex stock options gets turned into one single powerful number. So here's our game plan. We'll break this down into 5 parts. We'll kick things off with a clear definition. Then we're going to walk step by step through the 3 main phases of the calculation. And finally, we'll wrap up with why any of this actually matters to you as a trader or an investor. So, how in the world do you put a number on an emotion like fear? Well, the secret is hidden in the options market. The VIX is basically an engine designed to read the prices of dozens of S&P 500 options and then translate all of that market chatter into a single number, the market's best guess for volatility over the next 30 days. All right, first things first, what exactly is the VIX? Now, the most important thing to get about the VIX is that it's not looking in the rear-view mirror. It's not telling you what the market did. It's a forward-looking forecast. It does this by constantly scanning the real-time prices of a whole basket of S&P 500 options, we're talking both puts and calls, to gauge what investors are willing to pay right now for protection against future market swings. Okay, so if the VIX is built out of options, the logical first question is, which ones? Because the selection process is actually incredibly specific. The whole calculation really happens in 3 main phases. See, to get a really precise 30-day forecast, the VIX can't just use one set of options. So first, it selects 2 different sets of options with 2 different expiration dates. Then, it runs the math and calculates a volatility number for each of those sets. And in the final step, it just blends those 2 numbers together to hit that perfect 30-day target. So, the VIX uses 2 groups of options, what it calls near-term options, which have more than 23 days until they expire, and next-term options, with less than 37 days. This is pretty clever because it means our 30-day target is always perfectly sandwiched right between these 2 expiration dates. And to make sure it can always find options that fit this window, it pulls from both the standard monthly options and the weekly ones. And one last crucial rule, it only includes options that have actual bids, which ensures all the data is coming from active liquid markets. Now, before we can even pick the options, we need to find the market's expected future price for the S&P 500. This is called the forward index level. And essentially, all we're doing is hunting for the one strike price, where the price for a put and the price for a call are almost identical. This gives us the true at-the-money point, which becomes the anchor for the entire calculation. Once we have that forward level, we can build our strips of options. We start with K0, which is just the strike price sitting right below that forward level we just found. Then, we grab all the out-of-the-money puts below that point and all the out-of-the-money calls above it. By using this range of options, we're capturing the market's expectation for all sorts of potential outcomes. And right at that K0 strike, we actually use both the put and the call to anchor the whole thing. Okay, time for the math. Let's take a look at the actual formula that turns all those different option prices into one single volatility figure. All right, I know this formula looks intimidating, but let's just pull it apart. This is what we use to calculate the variance, which you can just think of as volatility squared for now. We have to run this calculation twice, once for our near-term options, and then we do it all over again for the next term ones. That big chunk on the left, the sigma part, that's where we add up the contributions from every single option we selected. And that little bit on the right is just a small correction factor. The first few variables here just set the scene. T is the time to expiration, and it's calculated right down to the minute to be incredibly precise. F and K0 are that forward price and key strike price we already figured out. They basically anchor the entire calculation in place. Now we get to the data from each individual option in our strip. Ki is simply the strike price for each option, and Q is its price, specifically the midpoint between the bid and the ask. R is the risk-free interest rate, and that delta Ki is just the gap between one strike price and the next. These are the raw ingredients that we're pulling directly from the market. And this is where it really gets interesting. You can see here how much each individual option contributes to the final number. The key insight is that an option's contribution depends on its price, but it's inversely related to its strike price squared. What that means in plain English is that the options that are way far away from the current price have much, much less impact on the final calculation. At our K0 strike, we just average the put and the call. And when you add up all these tiny little contributions, you get the main component of our variance number. So after we run the numbers and apply that little adjustment from the formula, here are our results. The variance for the near-term options comes out to 0.01846. Then we do the exact same math for our next-term options, and we get 0.01882. Perfect. Now we have the two key numbers we need for the final step. So we've got two different volatility numbers, but the VIX needs to be one single 30-day forecast. So here's how we blend them together. This final step is really just a weighted average, and it's all based on time. Imagine our 30-day target is on a timeline, sitting between the near-term and the next-term expiration dates. Well, the closer one of those expirations is to our 30-day mark, the more weight its variance gets in the final mix. Simple as that. Once we have that blended number, we just take the square root to turn variance back into a standard volatility, and then multiply by 100 to get that final VIX value you always see quoted. And that weighting is all about precision. I mean, we are literally counting the minutes. NT1 is the number of minutes left for the near-term options, NT2 is the minutes for the next term. Our target, N30, is just the total minutes in 30 days. The formula simply uses these minute counts to create the perfect weights for our average. So we plug in our two variance numbers, we apply that time weighting, we take the square root, and we multiply by 100. And after all that math, the final result for this example is 13.69. That is our VIX index value. Okay, we have just seen exactly how the VIX is built, piece by piece. But why should you care? Well, it turns out this number isn't just a boring statistic. It's an incredibly powerful tool, and it's even a tradable asset. Here it is. This is the relationship that made the VIX famous. It generally moves in the opposite direction of the stock market. So when the S&P 500 falls, fear tends to rise. The demand for options goes up, and the VIX tends to spike. This strong negative correlation is exactly why people call it the fear gauge, and it's why some investors use it as a way to hedge their portfolios. So in the end, the VIX really plays three key roles. One, it's the undisputed benchmark for U.S. stock market volatility. Two, it can be a really powerful tool for diversifying a portfolio because of that negative correlation. And three, and this is maybe the most important part, because its calculation is so transparent and rules-based, you can actually trade volatility itself through VIX futures and options. And, the index wasn't always this way. It's actually evolved quite a bit. The original version from 1993 was based on the S&P 100. The really crucial update came in 2003, when they shifted to the broader S&P 500 and introduced the methodology we just walked through. That's what turned it from an abstract idea into something you could actually replicate and trade. And that opened the door for futures in 2004 and options in 2006. More recently, in 2014, they added weekly options to make the calculation even more precise. So, what's the bottom line here? The most important thing to remember is that the VIX is not predicting which way the market is going to go. It's measuring the market's collective guess at the size of the move. It's a snapshot of uncertainty. So the next time you see the VIX number, you'll know it's not just some random figure. It's the output of this sophisticated engine constantly calculating the price of risk itself. The real question is, what is it telling you to prepare for?